Hello, I'm Mike, the host of Small Business Capital Radio. I'm here today to talk to you about conflict in small business capital. And I'll define small business for the purposes of this conversation as businesses with revenue from 100,000 to 100 million. Mark Twain once said something to the effect of, bankers are the kinds of guys who will loan you an umbrella on a sunny day and ask for it back the first sign or forecast of rain. Well, that's not entirely true, and it's certainly not a condemnation of bankers. There's regulatory effects and supply and demand and many other things that come to play. It is something that business owners feel from time to time when they're out looking for capital. So this is driven primarily or in a large part by supply and demand. And it's really more than just price, because that's usually what happens in supply and demand. Interestingly enough, in capital, if as a lender you're getting a very high price, you're risking default. So you may be hurting yourself by increasing your margin. So it's a little bit of a different situation in supply and demand than normal. At any rate, this supply and demand is not in balance. In other words, the demand for capital today is much greater than the supply. And I'll break that down into debt capital and equity capital. Debt capital is traditionally less expensive capital. It's considered to be less risky. Equity capital is more expensive. It's considered to be a little more risky. So with debt capital, there's probably a 2-to-1 gap. In other words, there's twice as many people looking for capital as there are lenders providing capital today. In equity, it's 10-to-1 or higher, so it's a much more difficult process in equity than it is in debt. What's happening is that's now shifting the sales responsibility from the traditional view to a new view. In other words, in traditional views, the supplier or provider of a service or product would be selling the consumer, or in this case borrower, of that product or service. Because of this tremendous shift in supply and demand and imbalance, we have a situation where now, as a business owner or borrower, we need to become the salesperson. We need to sell our deal to those who do have supply. And part of doing that is understanding the lender perspective. In other words, we want to know what their needs are as lenders or investors. And we want to know what kind of criteria they use. In order to do that, let's talk about lender investor needs first. And if you want a little more detail on this, I really recommend you go out and get something like Jim Rogers' book, The Investor Biker. That's a great fun place to start. At any rate, there's 4 basic needs that any investor or lender needs. Number 1, they want to protect their capital. Okay? Number 2, they want to find an undervalued asset to invest in, where number 3, there's a catalyst event, either internal or external coming, that's going to make that asset worth more money in the near future. And the 4th thing that a lender or investor looks for is liquidity. They need liquidity. They need to be able to get their money back. That's part of protecting their capital. So the lending industry has 3 basic criterias that they look at for determining whether to provide capital. Number 1 is cash flow coverage. So is there sufficient cash flow in the business to cover the debt service or the debt payments? Next, asset coverage. In the event of a default, are there sufficient assets to make sure that the original principal is protected in that event? And the 3rd criteria that lenders are looking at is credit. What's the credit history of the individual owners? And what's the credit history of the business? In order to shift into a salesperson role and sell our business to lenders or investors, we need to use storytelling. That storytelling needs to be both quantitative, financial, and qualitative. So quantitative would be things like the profit and loss statement, the balance sheet, the statement of cash flows, the forecasted results for the future. Those are quantitative items. Okay? The qualitative items would include things like, what are your plans and strategies? Who are your team members? Who are your customers? Who are your suppliers? We've got to tell that story. We've got to be able to tell it in both a written manner, a verbal manner, but also need to tell it now in a video manner. People are looking at videos. We, in our practice, We produce videos like this for every single deal that we submit to the lender community. In those storytelling events, whether it be written, verbal, or video, you need to make sure that you address all aspects of both the investor-lender need and the 3 criteria. Let's just review those. Lender-investor needs include protecting capital, finding undervalued assets with a catalytic event about to happen, internal or external, and liquidity. The funding criteria include asset coverage, cash flow coverage, and credit. So we want to make sure in our story that we're telling to the lender community, we're including all those items, and we're doing it with quantitative and qualitative data. If you want to learn more about this process, every Wednesday at 1 p.m. Eastern Time on our Small Business Capital Radio, we talk about these issues, and that's at www.w4cy.com, and the recordings are available at www.iheartradio.com. If you'd like an individual consultation, in other words, talk about your business needs and opportunities, call me at 844-249-3621. I look forward to helping you.